Hey everyone, this is Christopher here. So in this video, we're going to talk about one of the most common used option selling strategy called short strangle. Okay. So in strangle is a combination of put and call. That means we're going to sell one put, which means we expect the price to be above, and we are going to sell one call, which means we're going to expect the price to be below. Now let's look at this in the Bitcoin chart. So Bitcoin right now is around 97,000. So we can take a view that the price will be above 80,000. We can also take a view like we expect the price to be below 120,000. Okay, so I've noted this by the blue lines. Now let's take the expiry as 21st. Okay, that is the next weekly expiry. Okay, now there are 7 days to this expiry. Now, as I plotted, my view is that price will be above 80 and the price will be below 120. To implement this view, we'll be selling 180,000 put and we'll be selling 120,000 call. So a combination of this put and call is called a strangle. So here the advantage is that the price can be anywhere between these two blue lines. Okay, even if it does a gap up, liquidity hunt or anything, doesn't matter. Whatever it does, no issues. If as long as the price is below this blue line and above this blue line, by 21st November, we will get profit. So this is how a strangle will look in chart. Now let's see how we can deploy this in options. So in CoinSwitch platform, you can go to options. Make sure you are trading in INR and the prices are shown in USDT. Okay, here I have selected Bitcoin and the expiry date is 21st November. Here there is a new feature called margin mode, which you can switch between cross and portfolio. Portfolio has a lower margin mode. That is what we are going to use it for. Okay. So we said the price is going to be above 88,000. So we can click on that 88,000 in the option chain. All the puts are on the right side. All the calls are on the left side. So if we sell 88,000, okay. So only if we sell 88,000, we'll get the view that the price we expect is going to be above 88,000. So when we sell this 88,000 put, which is 295, and of one lot, the margin required for this in portfolio mode is around 4,000 rupees. Okay. Now, the profit that we get for this is approximately 277 rupees, which we can see in the estimated P&L. Okay. So, the ROI for this we can see easily when we switch it to seller mode. So, we get 6.11% ROI. Okay. So, if we sell this particular put of 88,000, we get a 66.11% if the price stays above that till November 21st. Okay. Now this is put. Now similarly, we can also sell call because our view was that the price will stay below 120,000. So since there is no 120, we can do 121. So that gives us a profit of 0.72%. Okay. So when we combine both, we get approximately 7% profit. So when we come back to the future chart, we can see that if the price remains between these two blue lines, we get 7.1% profit in the coming week. So that's how a strangle is. Similarly, in the option chain, we can also see delta. So delta is rate of change of price. And we can see that by clicking show Greeks. So you see the 88,000 put that we have sold is of 0.09 delta. And the 121 call that we decided is of 0.01 delta. Okay. So this is how you can see delta in option chain and how you deploy a strangle. Now what you have done right now is you have sold one put and one call. Okay. We have sold one put and call. Now this is called as single leg strangle or just short strangle. Now there's a more efficient method. There is a more efficient method than selling one strangle, which is called as multi-leg strangle. I'll show you an example of that, which I already deployed in Ethereum. Okay. So here you can see that as the market is moving, I'm selling multiple strikes. Okay. But I also have a certain number of calls and I have certain number of puts depending on the trend that I am having. Okay. So this is called as multi-leg strangle and we'll be seeing this soon. So this is strangle where we expect the price to stay between 2 different strikes. And if it stays, we get profit. Thank you.